Good product, bad partner. The risk you can't afford. Head of a European trading company who had just lost a large shipment of goods worth a lot of money. The goods had been sent to a trusted distributor in Nigeria, someone they've known for over a year, who had shown interest, requested samples, even visited their booth at a trade show in Lagos. But after that shipment, the payment stopped. The distributor was making excuses, blaming delays on foreign exchange, on clients not paying, even on the weather. And then one day, the calls, WhatsApp messages, and emails simply went unanswered. No money, no product, no clear legal path to recovery. That's when the company called me. Here's the truth. Doing business in Nigeria has enormous upside, yes, but the wrong distributor can quietly turn your opportunity into a loss. In a market where deals are built on both paperwork and trust, it's critical to know the red flags before you commit. And trust me, the signs are always there. You just need to know what to look for. In this piece, we'll break down 7 clear warning signs that you might be dealing with the wrong distributor in Nigeria and what to do when you see them. Red flag number 1. They ask for financial help or free samples too early. Let me put it plainly. If your first conversation with a potential distributor includes requests for free products, discounts, or financial help, be cautious. Good distributors understand that business is built on mutual investment. If they truly believe in your product, they will be willing to take a reasonable commercial risk, just like you are doing. Yes, offering samples can sometimes be part of a sales strategy, but only after commitment has been demonstrated, only after there is a formal agreement or at the very least, a paid first order. Think of it this way. If you walk into a luxury dealership and ask for a free car to test with your network, you probably won't be taken seriously. It's not different here. A distributor who leads with help us first before placing any order is likely not ready or not serious. In some cases, they might even be looking to flip these samples, sell it in the market, or rebrand them as their own. Others may simply lack the capacity to fund even basic operations and hope you carry the weight. What to do instead? Offer to provide sample units with the first paid shipment. Structure deals where marketing, support, or sample units are conditional on volume targets or long-term partnership milestones. Keep your due diligence high even when conversations sound promising. Because in Nigeria, as in many high opportunity markets, the most expensive mistake isn't a bad product, it's trusting the wrong partner. Red flag number 2. They show little interest in your product. Not too long ago, I was advising a European company that sold frozen food products. They had connected with a Nigerian importer who seemed interested on paper. Emails were polite, the conversation flowed well, but something was off. During one of the meetings, I asked the distributor a basic question. What's your plan for introducing this product to your customers? The distributor paused, then said, well, we'll see. That was all. No excitement, no real enthusiasm, no real understanding of how the product worked, no mention of marketing strategy or customer segmentation, just vague answers and polite smile. And here's the truth. If a distributor isn't excited about your product, they won't sell it, trust me. In Nigeria, where distributors carry many brands and competition is fierce, enthusiasm is the difference between a passive shelf item and a product that moves. So how do you spot this red flag? They don't ask questions about the product features, positioning, or local market fits. They've never sold anything similar and don't offer a plan to enter the category. They focus only on price, not on value or customer demand. You wouldn't hire a sales manager who who didn't believe in your product. Don't partner with a distributor who treats your product like an afterthought. What to look for instead? A distributor who understands your product's category or is eager to learn quickly. Someone who talks about target markets, uses case studies, and sales channels. A partner who asks you, how can we train our team to push this better? Because in a fast-moving, price-sensitive market like Nigeria, passion sells and indifference kills. It kills your product. Red flag number 3. They request goods without making a down payment. Some years ago, a client from Europe reached out with a concern. They had been in discussion with a Nigerian distributor who seemed very confident. Friendly emails, fast responses, and big promises. Then came the deal breaker. The distributor asked them to ship the first container without a down payment, saying, once the goods arrive, we'll pay right away. Trust me, trust us. We have the buyers lined up. It sounded tempting, yes, but here's the reality. In any market, especially Nigeria, sending goods without payment is risky business. So even if the distributor has good intentions, they may lack the liquidity or financial discipline to pay after delivery. Worse still, some use the goods first, pay later method to get inventory they never planned to pay for. You wouldn't give your car keys to someone who hasn't paid for the car. Don't hand over your products that you sweated to manufacture under similar conditions. They avoid discussions about payment terms or push for open credit without track record. They give you vague answers when you ask about the cash flow or buyer readiness. They insist that Nigerian customs or buyers require them to take stock before payment. What to do instead? For a new distributor, always require a down payment. Even a small one shows commitment. Use letters of credit, secure deposits, or staged payments. If the distributor truly believes in your product, they'll be willing to share some of the risks upfront. Pro tip: trust can grow, but it should be earned, not blindly given. Even long-term partners can default when their cash flow is disrupted. Take for example, during COVID-19. Payment terms must be clear, firm, and enforced from day one. No compromise. Because in Nigeria, as in many markets, getting paid is not automatic, it's strategic. You have to plan for it. You have to be strategic. Red flag number 4. Visa requests disguised as business intent. Some time ago, I was consulting for a European company that had just made contact with a potential Nigerian partner, a Nigerian importer and distributor. The discussions had barely started. No orders, no deals, no defined interest in the product. Then, out of the blue, the distributor made a request. Can you help us get a visa to visit your factory? Now, in theory, of course, a factory visit makes sense, but timing is everything. In this case, the request came too early, before any product training, purchase commitment, or even detailed business planning. And that's a red flag. Here's why. Some visa requests are not about business, they are about travel. It's unfortunate, but this happens more often than companies expect. Some distributors misuse factory visit invitations as a means to travel internationally. For reasons unrelated to business, they are going for trips. Once the visa is granted, the business conversation dies quietly, dies gradually. They ask for visa assistance before any deal or purchase has been agreed. That's one of the key warning signs. They avoid virtual meetings or product demos, but insist on international travel. Again, they mention visiting your country more than they discuss selling your product. What to do instead? Offer virtual plant tours, sales webinars, and remote onboarding first. only entertain visa or travel support after initial purchase discussions and basic due diligence has been met. Tie visit to sign agreements, joint planning sessions, or distributor training milestones. Let me give you a quick tip. Factory visits should come as a step in the process, not the first step. They are valuable, but they must be earned through demonstrated seriousness and business intent. Because in international trade, just like in life, people show their priorities by what they do, not just by what they say. Red flag number 5, payment delays and banking excuses. One of the most common and frustrating issues companies face is the disappearing payment. And trust me, in Nigeria, it's a common issue. I once worked with a brand that had been supplying a Nigerian distributor for over a year. Early orders were small and paid upfront. But as trust grew, so did the volume and the credit terms. Then one day, the distributor said, "We have sent the payment. Maybe it's stuck in the system." 2 weeks passed, nothing. A month passed, still nothing. Eventually, the email slowed, then stopped altogether. Here's the hard truth. In Nigeria, late payment is often the first sign of bigger trouble. Yes, currency controls and banking delays do happen, but legitimate distributors communicate clearly, provide proof of transaction, and follow through. When a partner begins offering vague excuses, especially repeatedly, it's time to pause. Tip: the bank must be holding it. They will say the bank must be holding it. There is a system glitch. We sent it, just wait a little more. These are not confirmations. They are stall tactics. They're trying to delay you. What you should do: always have clear payment terms in writing and enforce them. Ask for swift confirmation, payment receipts, swift codes, or bank transaction slips. Have someone on the ground or through your bank verify that funds are en route. Be cautious if delays become a pattern. Even if the distributor has been reliable in the past, be cautious. A distributor deal that looks great on paper is worthless if your payment never arrives. And legal recourse in Nigeria can be costly, slow, and difficult to enforce internationally. Protect yourself, protect your company with clear boundaries, and act early when red flags show. Red flag number 6, blaming price and Forex without taking ownership. A few months ago, I spoke with a regional sales director from a consumer goods company in Lagos. They had just pulled out of a deal with a Nigerian distributor who had spent weeks complaining about one thing. Your prices are too high and the Forex rate is killing us. Here's what I told them. That's not a negotiation. It's a warning. Yes, Nigeria has real Forex exchange challenges. Yes, I agree. The naira can fluctuate heavily against the dollar or euro, but serious distributors always know this and they plan for it. They plan for it, they hedge, they adjust, and most importantly, they don't expect you to absorb all the risk. Constant complaints about price even before selling a unit, that's one of their key signs. Blaming foreign exchange as the main reason for delay, that's another sign. Expecting you to reverse your pricing downward without a market test or sales effort, that's another clear sign. This is not partnership, it's passing the burden, passing the risk. What you should do: be transparent about pricing and your own cost structure, but firm. Offer scalable entry options, e.g., smaller trial orders, flexible terms on first deal. Ask what they are doing to manage Forex risk on their side. If the answer is nothing, take note. What to watch out for: a real distributor talks about the consumer, the channel, the strategy. A risky one talks only about price and problems here, problems there. Because at the end of the day, if they aren't willing to own part of the market, building process, they aren't ready to earn the business. Red flag number 7, big claims, no track record. A while back, a client forwarded me a pitch from a Nigerian distributor who claim to supply all the major supermarkets, all the major hotels across Nigeria. The email was polished, the website looking great, fantastic, and LinkedIn page listed impressive partnerships. But when we dug deeper, nothing. No verified client references, no trace of them in industry news. No one in the local sector had ever heard of them. In Nigeria, appearances can be misleading. The truth is, anyone can set up a website, print business cards, or use logos on a PowerPoint deck. But when there is no evidence of actual delivery, scale, or reputation, it's time to start asking hard questions. What are the signs? They name drop major buyers to impress you, but can't provide verified references. Their office address is vague, or it leads to a small shed somewhere. Their company has no footprint in press mentions, trade directories, or B2B circles. What you should do? Always ask for past client contacts and follow up directly. Search for third-party mentions of their business in local news, industry events, local trade shows, or procurement listings. Consult with on-ground advisors such as myself who know the market and can validate their presence. Here's a quick test. If a distributor says they supply a major chain or government agency, blah, 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 check if their brand is mentioned anywhere online. If not, proceed with caution. In high opportunity markets, the cost of believing the wrong story can be heavy. Due diligence isn't just smart, it is essential. It is non-negotiable. Let's wrap it up. In Nigeria, the wrong distributor costs more than money. After over a decade advising business across Africa, Nigeria, and beyond, one thing is clear. In Nigeria, choosing the right distributor isn't just important, it's everything. The wrong partner can drain your time, resources, and trust in the market. They may seem convincing at first, friendly, connected, full of promises, but the red flags are always there for those who know what to look for. So let's recap. The first sign, first red flag, they ask for financial support or free samples upfront. 2, they show little enthusiasm or understanding of your product. 3, they request goods without any down payment. 4, they push for visas or facility visits without a clear deal in place. 5, they delay payments and give vague banking excuses. They focus on price and Forex challenges. That's 6, but no solutions. 7, they make big claims with no visible track record. Your product may be world class. Your systems may be strong. But if your local partner isn't reliable, committed, or transparent, you are at risk. What should you do? Be thorough with your due diligence. Start small, build trust slowly. Don't start with 2 containers, 10 containers. Ask questions, verify claims, seek local insights. Partner with people who are willing to share the risk, not just the reward. Because in Nigeria, the brands that succeed aren't just the best built, they are the best backed by local presence. And most of all, by the right people. Now, you know the signs. The rest is up to you. Choose wisely.